Hello and welcome to this Q2 2023 MPS update from AJ Bell. I'm James, a fund manager here at AJ Bell, and I'll be taking you through this short presentation. This presentation will follow a slightly different format to usual, with the aim of leading into portfolio performance with a little more context. So after a brief refresh on AJ Bell investments, we'll look at economic and market developments, look at some key themes and what's going on there, and then we'll look at MPS performance. We'll then go back to what happened at the recast of the SAA in January 2023 and how the portfolios are positioned and how that's looking now given the outlook. So just to recap, AJ Bell is set up to provide and manufacture simple, transparent, low-cost investment products for customers. These come in the form of a core investment range with two types of portfolios, so growth and income. All portfolios are designed to behave in a predictable manner with respect to volatility, and as such can be mapped to risk profiler outputs. The risk profiles of the growth range map to Dynamic Planner's middle six risk profiles, those being DT3 to DT8. These come in the form of MPS 1 to MPS 6 here at AJ Bell. The asset allocation associated with these six risk profiles are centrally set here at AJ Bell and are actively managed. There are 5 ways of implementing this asset allocation structure, and these focuses on differences in the end investment implementation. So for example, the passive MPS still benefits from our active asset allocation, but uses passive funds and ETFs to implement. The active range looks to use a selection of active fund managers to fulfill the same asset allocation structure, and the Pactive range is a blend of the two implementation types. There's also a responsible MPS range for those who like that type of implementation. And finally, there's a growth fund range, which uses passive implementations. Alongside that, there's an additional responsible growth fund, which maps to risk profile 5 or DT7. For income investors, we have 2 risk profiles that we refer to as income and growth. Income is focused on generating income whilst maintaining capital value, whilst income and growth is focused on generating income and, as the name suggests, some growth in capital. These can be implemented in passive and active form via MPS and via the 2 AJ Bell funds, forming 6 active portfolios. The Retirement Portfolio Service is designed as a centralized retirement proposition to manage sequencing risk in a simple, transparent and understandable format, which is increasingly key as customers progress through retirement. It's designed around 3 easy to understand buckets. The income and growth funds form the medium to long-term investments via 45% allocations and aim to produce an income in the range of 3 to 5%. The portfolio also allocates 10% to cash at outset as a reserve to negate any risk with regards to the first 2.5 years of income. The overall objective is to pay out 4% income to customers per annum uplifted for inflation based on the initial capital invested. The allocation between the 3 buckets is rebalanced according to a set of rules that are algorithmic in nature, with the aim of reducing sequencing risk further. Now, moving to this quarter's update. The economic backdrop, I think it's fair to say, is mixed. Inflation is a key topic, particularly in the UK, where it's been a little hotter than expected. The US economy looks to be in good shape and seems to have a better handle on the inflation situation. Whilst over in Europe, there's some weakness, and that's indicative of a wider global slowdown. And that some of that slowdown is coming from China, which has reopened from its pandemic restrictions in a manner that's kind of underwhelmed, and that plays out in equity market performance as well. Looking at inflation in more detail, this chart covers up to the end of May in terms of the report from the ONS. It's worth noting that it doesn't cover the headline CPI in the US, but a measure that's been harmonised with the UK and Europe in that it excludes shelter costs, which is quite topical, i.e. it excludes home ownership costs, which is very different in the US because they tend to fix their mortgages on a longer term basis, such as 30 years, whereas in the UK we tend to roll over 2 to 5 year fixed deals, and therefore the impact on the consumer of raising interest rates is felt much more readily in the UK relative to the US. In terms of the data, the UK moderation has come at quite a slow pace, with service sector data looking a bit sticky. Goods prices are now thankfully starting to see some stabilisation, and fuel actually made a negative contribution in the June report, which has now been released. The Bank of England has been acting to cool the economy in response to this inflation, with rate hikes and in an effort to preserve its credibility. As the base rate has now hit 5% and may top out towards 6%, it's expected that UK inflation will begin to ease significantly. In Europe, they don't seem to be contending with the same dynamics with respect to the service sector, and are more readily seeing the falling energy prices come through into the data. Again, in the US, they seem to have a much better handle on the situation in terms of inflation, and the Fed was actually able to skip a rate hike at its last meeting. The overall point here is that inflation data is looking a bit more differentiated globally now, and that's starting to influence policy and markets in different ways globally. Now, that may be true for a time, but at some point in time, the policies might come back together and form kind of quite a coherent policy. Some differential is also seen in the wider economic data. In the US, the consumer side of the economy has been in good health, and the employment trends have been stronger than pre-pandemic. The Fed are therefore alive to the possibility the economy could run quite hot and exacerbate any inflation or further spikes in inflation, even though prices are coming down quite mechanically with fuel prices falling and in some cases food prices falling. Globally, the picture is a bit different. China's release from COVID has not gone as planned, and that's having an impact across Asia and Europe. Part of this is because of the global rebalancing of trade post-pandemic, which has shifted demand from goods towards services. A final point to make here is that because of that weakness in China, and particularly around goods and the export of goods, their factory gate prices or producer price inflation has been running at negative figures, so it came out at minus 5.4% in June. So it's not impossible that we start to see deflation being exported from China to the rest of the world via lower goods prices. Moving to markets, there has been an easing in volatility from the higher levels seen around the Q1 spike that we saw around the wobble in the banking sector. This has enabled the trend to resume in bond markets, that being a trend higher in yields, and the expectation that central banks will continue to tighten policy. In equity markets, the calm has facilitated a rally around a small selection of US stocks that are heavyweights in the US indices. We'll take a look at that in more detail later on. Looking at the barometers measuring broad conditions for types of implementation, i.e. active or passive, there's less differentiation in terms of this last quarter relative to the last four, although it's worth noting that the scale on the top three scales are different to the bottom three, in that the top three cover minus 10% to plus 10% and the bottom are minus 25 to plus 25%. Taking the top left in turn, the rally in large US stocks, many of those are considered to be quality stocks, and that's favoured better conditions for passive implementation. That's broadly what we've seen across the last year in the bottom left-hand chart, although the tech sell-off weighed more heavily on large cap indices due to the distribution of some of those tech companies. And that can be seen on the right-hand scales. In bond markets, high yields on government bonds have been met with stable yields in credit markets, i.e. there's been spread compression from the wides of Q1. This has favoured active selection relative to indices that are broad-based and is consistent with what we've seen across the last year. Moving on to the barometers, focus more on relative performance of the AJ Bell range relative to the peer group. Here we can see the impact of currency, with the US dollar generally being weak and the pound generally being strong versus major peers. We can see that on the top left chart over the quarter. This acts as a headwind for any overseas investments that are unhedged in terms of currency. So international equities and international bonds. Particularly relative to the peer group, the AJ Bell range carries greater unhedged international bond risk. Moving on to the barometers more focused on relative performance of the AJ Bell range relative to the peer group. On the top left scale, we can see the performance of the pound versus the dollar. The dollar has generally been weak against international peers, and the pound has also been strong against major peers. This acts as a headwind on overseas investments that are unhedged in terms of currency. So for the range, this is principally the international bond and international equity exposure. This differs from the peer group in that the international bond exposure is unhedged, whereas some peers hedge a lot of that exposure. In bond markets, the move higher in yields has come across the curve, leaving less between having longer or shorter duration. As you can see, it's slightly tipping towards shorter duration. That's been a slight tailwind for relative performance. If you look on the far right scale, having high yield relative to government bonds has been a better place to be, generally because of credit spread compression. In equity markets, so the chart that is on the second from right, the rally's been led by developed equity markets, particularly the US. Emerging markets have done well, but that's been dragged down by China, which is a large index constituent. If you took China out of those and measured something like Taiwan, India, and Brazil, which have done really well, the performance scale would be much more balanced. The MPS range has a much more balanced exposure to international equities than what you find in most indices. So generally it carries less risk in the US and more in emerging markets, and therefore that's been a detractor over the quarter and over the last year. Here we can see the impact of the stronger pound versus major peers. Over the quarter, this is partly because the Bank of England was expected to react more aggressively to inflation than the peer group. Over the last year, it could be said that the political side of the equation has become a bit more stable, and sterling's been repriced from pretty depressed levels, which you can see on the bottom chart. A couple of double-digit returns relative to the peer group. Another area of note is the Japanese yen, particularly over the quarter, which has been very weak. The Bank of Japan continues to run pretty loose monetary policy, even though inflation is coming in higher than target. And we can see that in some of the currency equity returns on the next slide. So developed equities have performed quite well, the US and Japan. Japan would, in fact, in local currency terms, be leading. However, this chart shows in GBP terms. So major Japanese equity indices are actually as high as they've been since the 1990s. But due to the currency depreciation, that return for UK-based investors has been eroded. We can also see EM and Asia performing poorly principally because of China. And Then we're coming back to the US equity market performance. The technology sector houses most of those 7 names that have done very well. And they're also considered to be growth and quality companies. So you can see on the far right chart, equity factor performance, those have been very strong over the quarter and indeed over the last year. On the flip side, value and dividend paying equities have performed quite badly in relative terms. This is partly because energy and commodity prices are falling as global growth seems to be stalling, and particularly in China. That's impacted the basic materials and energy sectors. Financials have staged a pretty muted recovery from the Q1 volatility, and so too have real estate companies, where we've started to see net asset values falling in response to higher interest rates. Borrowing costs are also starting to show some stress in the sector. These are 2-factor, so value and dividend, and 4 sector performances, so financials, basic materials, real estate and energy, that have been a large headwind for the UK equity market, and that's subsequently lagged major developed market peers, as you can see on the top left chart, and now too on a 12-month basis. Over the year, generally all of the trends hold. However, the European equities performed really strongly in Q1, and that puts them ahead on a regional basis. And that was down to some large quality companies performing quite well during that period. As mentioned, bonds have been less differentiated, especially when it comes to duration. So if you look at the top left chart, the scale on there is very zoomed in, so from -3.6 to -4.8. As you can see, the difference between having short and long duration, there's only 70 basis points in it. On the short end, -4% relative to +10 on -4.7%. And actually, at the middle of the curve between 3 and 10 years, there's not been a lot of differentiation there. And that's because now yields, in terms of their actual movements, have to move much further at the shorter end of the curve relative to the long end of the curve to produce those types of returns. So the 2-year US Treasury yield moved around 90 basis points during the quarter higher, whereas the 10-year only moved 30 basis points, but you still saw a similar return in those maturities. Credit quality has been dominated by spread compression from the wides of Q1, and the naturally higher income that you get on high yield and EM hard currency debt has offset some of the capital values declines that we've seen with outright yield rises. That background on markets should leave performance largely as expected for the quarter. Bond-heavy portfolios such as 1 and 2 have underperformed, whilst higher up the risk spectrum, the underperformance of emerging market equity has made an impact, particularly for MPS 6, and that leaves 4 and 5, which have just had just about the right amount of developed market equity relative to emerging market equity to perform well, and haven't been carrying much in the way of high quality bonds. It's notable that the income portfolios have underperformed, which is owing to the factor and sector tilts inherent in equity income indices, i.e. they don't own a lot of what's performed very well in the US, and instead they own financials, real estate, energy and basic materials. Over the 1 year, a difficult quarter drops out of the numbers and is replaced by something more sanguine, definitely in terms of equity markets. There was still a poor bond market performance in late 2022 that's still in the numbers, and that's evident lower down the risk spectrum. Overall, on a 1-year basis and 3- and 5-year basis, returns are roughly commensurate with what level of risk you've taken. Aside from in MPS 6, where the bias to emerging market equities has dragged down performance, especially so over the 1 year, that's somewhat dropping out of the numbers on a 3-year and 5-year basis. On the active side, there is little drift versus the passive over the quarter in terms of the growth range. However, the income range has notably outperformed the passive side. This is owing to the equity content that tends to be much more broadly invested in active funds that are focused on income, whereas passive income equity indices tend to crowd in sectors, as we've said, such as financials and real estate. This has led to active income MPS to outperform the passive counterparts over 1 year, and this prevails at the 5-year numbers, but not the 3-year numbers. The 3 year has been impacted by the recovery in COVID, from COVID in 2020. If you think back to Q3 2020, the performance of the market was quite growth orientated. The Pactive, as a blend of the two implementations, has seen underperformance of the active growth range moderated by the blend of passive. Now, recapping how portfolios were repositioned coming into 2023 with the recast of the strategic asset allocation. That broadly pulled equity market content down, put bonds and cash allocations up, and so too a small allocation to alternatives. This came as a result of a flattening in the efficient frontier, so the returns available on cash and bonds on a risk-adjusted basis appeared better than equities on a long-term basis. That was especially so for US equity indices, where allocations were reduced. And at the other end of the spectrum, global high yield bonds started to look very attractive just because of their outright yields. Overall, the duration was nudged up a touch, but still remains below the peer group. That was mainly in recognition that yields had moved a long way in a short space of time. In alternatives, the UK property came into the portfolios at the expense of infrastructure. That was essentially a switch from one quite interest rate sensitive sector to another, and that was purely on valuation grounds, i.e. there appeared to be a lot more in the price of UK real estate relative to what was in the price of infrastructure. The final area to note was that the tactical asset allocation process, or TAA, was not triggered at this SAA, as the environment appeared too uncertain to make any calls with any real conviction. Looking ahead, inflation remains a watchword, and the central bank policy response is arguably becoming less predictable at this point in the cycle. Markets seem satisfied that the fabled soft landing in the US economy has been secured, and risk assets are doing well on the back of that. That contrasts with some of the data that we see on a global basis, so we're quite mindful of that because monetary policy, as we know, works with long and variable lags. We're only just over a year into this hiking cycle, and it might be too early to say that that impact has been negated, particularly on the consumer side of the economy, where we know that the lags in the US are much greater than the UK. Finally, as ever, geopolitics has the ability to significantly impact markets. We're mindful of that, and it feels like that's becoming an increasing risk, not only around Ukraine and China, but globally, how countries are aligning themselves along the conflict lines. In terms of portfolio outlook, for the time being, we're happy to see the 2023 SAA mature in this sort of environment of unpredictability. Now, that could always be said for markets, but it does feel especially uncertain this year relative to history. And as such, we don't feel like we need to interfere with the positioning. We'll let that play out at the next SAA. And leave the tactical stuff on the sidelines. We feel like it's much better to focus on the long-term investment returns available rather than being knocked around by short-term market movements and try to adjust and time things. So that concludes today's presentation. As ever, you can keep up to date with the latest news and views regarding the portfolios on the Invest Centre website. And we also have the new Consumer Duty Hub available. Thanks for watching.